Hello and welcome to this event with Demos and the Institute and Faculty of Actuaries, the Great Risk Transfer. I'm just going to give us a couple of moments whilst people join, because it sometimes takes a bit of time for people to roll through the system. I can still see the numbers ticking up. Let me just say a little bit more about Demos. So Demos is a cross-party think tank involved in exploring the future, mostly with the public. So we try and bridge the gap between policymakers and the public and involve the public in all of the discussions and work we do. We are really excited to partner with the Institute of Faculty of Actuaries on this event. So before I say a bit more about that, the numbers are still ticking up. This is very exciting. I don't know why, it's like it's a virtual sort of ticker thing. Let me just wait 1 second. I'm gonna have a sip of coffee and then I shall hand over to lists in a moment. Right, so the numbers have stopped ticking up. So welcome again to anybody who was there in the second cohort. I'm Polly Mackenzie. I am the Chief Executive of Demos, a cross-party think tank. And here we're joined by the Institute and Faculty of Actuaries, who've put together a really interesting report about one of those macro trends in our society, the Great Risk Transfer, which is that over time, increasingly, more and more of the risk associated with life is being transferred from corporations, from businesses, and sometimes from the state to individuals. And that creates new pressures and new opportunities for how we manage both our financial services products, questions of what is the role for society and what is the role for individuals and what is the role for business or for the state. And obviously that question of risk has been absolutely kind of parachuted right to the top of the agenda over the course of a year of a pandemic in which the state was the only organization that really could step in to protect both businesses and individuals from a risk that nobody really could expect to be planning for, though perhaps the government could have planned for it a little better. That's a different event. So the Institute Faculty of Actuaries have looked both at the macro and the kind of the trend over the course of generations, but also the implications of these questions about risk. And to introduce some of the themes and ideas behind that report, I'm joined by John Taylor, who is the immediate past president of the Institute and Faculty of Actuaries. And then after he's told us about the way they see the world, we've then got two fantastic contributors, Stephen Timms, Member of Parliament and Chair of the Work and Pensions Select Committee, and Vicky Price, a fantastically talented economist and economic commentator. So I'll start with John. Tell us about risk.
Thanks, Polly. And yeah, it's certainly interesting to hear what you're referring to, the way that the government have stepped in to support businesses and individuals during the pandemic. But I think we would see that very much as an exception to the long-term trend that we're trying to draw out here in our report today. So hope to spend a few minutes just unpacking some of the findings and talking a little bit about the recommendations that we've landed on today. So I hope the audience find this useful. So first of all, I welcome the opportunity to be here with everyone to launch this important report, one that is the culmination of a process of campaigning and engagement that started at the beginning of 2020. And indeed, I remember the launch event that took place in a real building with actual physical participants in the real building. So we've been working on this for some time. And the Institute and Faculty of Actuaries has been examining the trend for institutions to step back from financial risk, leaving those risks to be borne by individuals. And this has happened over the last generation or so. And probably one of the most prominent examples has been the switch away from defined benefit pensions towards defined contributions. But that's only one, there are many others. And for the IFOA, as a body with the public interest at its heart, this is a good time to look back at the aggregate impact of this trend and consider some of the quite profound implications. And we're delighted, given the attendance here today, that many of you are interested in this area too, and may want to be part of forming solutions that can rebalance risks and offer better outcomes for individuals and society as a whole. Now, we heard at our launch event last year that this trend really started with the political ethos of the 1980s, where individual accountability was gaining increasing prominence ahead of collective accountability. And this created wide-reaching change across many societies. And in sympathy with that general direction, it meant lower institutional appetite for bearing risks on behalf of individuals. And so individuals have been very successful in reducing their own exposures to financial risks. But whilst those financial risks have disappeared from institutional balance sheets, they've not vanished into thin air. They do, of course, still exist, but they're now borne by individuals. And one of the consequences of this transfer from institutions to individuals is that it's also a transfer from the professional to the amateur, from the resourceful to the resource constrained. And for some individuals, those with resources and access to professional advice, this trend has offered more choice and an ability to personalise financial plans in a way that was hitherto very difficult. But outside of that fortunate minority, we believe the trend has damaging impacts for consumers and society. And in terms of harm to individuals, we believe the risk transfer represents an even greater systemic failure than celebrated scandals such as the mis-selling of payment protection insurance. Now, trying to reverse this trend is not realistic, and we're not advocating that. However, our campaign is dedicated to the idea that ultimately financial services, the clues in the title, should exist to serve consumers. We believe that there are opportunities to rebalance some risks away from consumers and back towards institutions in a way that is likely to benefit society. And so our report is calling for risk transfer to be treated as a systemic failure, and for policymakers, employers, and for the financial services industry to recognise the need for urgent action. We also recommend some practical solutions and commit ourselves to offer our actuarial expertise where it can help to promote solutions and best practice. Now, the great risk transfer extends beyond financial services to wider areas. For example, a worker in the 2020s is less likely to have a permanent employment contract than their parents' generation in the 1990s. They may even be in insecure work or on a 0 hours contract, the so-called gig economy. And in fact, the pandemic has illustrated that some within this group are more susceptible to a multitude of risks by nature of their employment status. And of course, in turn, this can come back to have implications for the availability of insurance. And so an individual assessed as high risk may mean that they can't access the insurance market at all, or not at an affordable price. And so the great risk transfer can amplify existing inequality. So excuse me while I take a quick drink. So, as we step back to look at this phenomenon at the beginning of the decade, what did we set out to do? Well, we wanted to do three things with this work. First of all, we wanted to gather and share evidence about the risk transfer and its impacts across society. Secondly, we felt that it was important to bring stakeholders together to debate the evidence and potential actions that can be taken to address the trend. And thirdly, we wanted to propose recommendations for action and to work with stakeholders, including policymakers, to drive actions that will have a positive impact in the public interest. We knew that it was essential that this campaign had to be grounded in a robust evidence base, and we ran a call for evidence last spring. And subsequently, we held a series of focused roundtables and engagements throughout the rest of 2020 to drill down on the issues and begin to form recommendations. The response that we received confirmed our hypothesis that there was indeed a pattern of risk transfer that was taking place across a number of areas. And it's not only a UK phenomenon, and there are lessons to be learned right across the globe. We had an international response to our call for evidence, and it generated a number of interesting corroborating examples, for example, on retirement provision in India, right through to the life insurance market in Singapore. And so we're able to form a much clearer picture of the trend with some examples including, back to the classic one in pensions, the shift from defined benefit schemes in favour of defined contribution arrangements, creating a situation where individuals had primary responsibility for savings for their retirement. And even though employers did still contribute, amounts were much lower than they had historically been, and individuals were exposed to much more investment and longevity risk than they had been previously. And if we look at insurance, those who had faced the highest risk and maybe had the greatest need for insurance were being priced out of the market. And without the protection that insurance provides, often we're living precarious existences where property, good health or income were in jeopardy, often because of situations beyond their control. And maybe a recent one in the UK, the 2015 Annuity Reforms, which meant that individuals were no longer required to buy an annuity. This resulted in more investment and longevity risk being borne by individuals, and indeed they needed to make sure their pensions pots lasted a lifetime. Now, the aggregate of impact can create inefficiencies for society and harm individuals as well. So to illustrate the inefficiency, what I would like to do is just step away from the macro for the moment and encourage us all to think about the micro, the very micro of an individual customer. So just try and imagine for the moment you're now a 70-year-old using drawdown to fund retirement. One of the questions you need to consider is how long do your savings need to last? Well, on average, such an individual is likely to live another 17 years. That's the kind of average life expectancy for a 70-year-old. But there's actually a 10% chance you're going to live a further 11 years beyond that. So, a reasonably prudent financial planning assumption would be to have a buffer of an extra 11 years worth of income in your plan, just to give you a degree of comfort that you're not going to run out of money in retirement. So quite a significant buffer required for someone self-insuring. Now, by contrast, imagine an insurance solution where there's a group of 100 such individuals. Well, their life expectancy is still another 17 years, but we get a very different answer to the question of how much extra buffer do we need to be confident that that money will be sufficient for the group. And because the variability in life expectancy for a group is much lower than the variability for an individual, in fact, we only need a single year's income per person to create a sufficient buffer. So just think about that for a minute. Instead of 100 individuals all needing a buffer of 11 years if they self-insure, clubbing together via insurance can reduce that buffer to a single year per person. So far more efficient and far less capital being held back in mitigation. And coming back to the big picture impact on savers, where individual savers a generation ago were once protected from stock market volatility by their employers and insurers, the current generation are now exposed to the ups and downs of the stock market. Where individual retirees could once look forward to a guaranteed income for life, they now have to worry about running out of money in retirement. So it's very clear that this overall trend can be not only difficult and expensive for individuals, but very inefficient for UK PLC. So during our call for evidence and subsequent engagement with stakeholders, we also learned about how well equipped an individual may be to deal with risk. And responses highlighted the increasingly complex financial decisions that people now have to make. And of course, it stands to reason that the more complex the decision, the more that any customer may be exposed to risk. And at the same time, it must be acknowledged that financial advice is not easily accessible or affordable to many consumers having to make complex risk management decisions. So we probably were left with, I would say, 3 key takeaways from this call for evidence. First of all, institutions with access to risk expertise are passing risk to individuals who by and large have less expertise. And there's plenty of evidence to show that many people have low levels of numeracy financial literacy and understanding of risk. And even the most financially literate may struggle to mitigate their risks given the scarcity of products that pool risks or offer guarantees. So in the report we're launching today, the IFOA has made a number of recommendations to policymakers and the industry to address some of the negative impacts of the great risk transfer. And we certainly like to think the actuarial profession is well placed to make such recommendations. You know, we work across many areas of the financial sector, including pensions and insurance, with a focus on understanding of risk and uncertainty. And in order to bring a distinctive and meaningful contribution to this debate, our recommendations therefore focus on the actuarial aspects of this transfer of risk, particularly in relation to pensions and insurance. So our work on the great risk transfer has demonstrated that this trend is deep-seated, long-term in nature, and rooted in some of the mega trends. I know that was a word you mentioned earlier, Polly, around demographic and technological change, as well as having roots in changes in social attitudes. So, as I've mentioned before, we believe that it is not appropriate to think in terms of reversing the whole risk transfer phenomenon. However, we think there are recommendations where there are specific opportunities to rebalance risks in a way that would benefit society. So we have two broad themes of recommendations that we're presenting today. The first is around rebalancing risks where we think it's feasible. And the second is around supporting consumers where they do have to make difficult financial decisions. So in the first area, the first theme, rebalancing risks, we do think there are opportunities to ease burdens for consumers in trying to manage complex risks by shifting the prime responsibility back towards institutions. And the mechanisms for achieving this will be structural changes to the market, to products and services, and often the legal and regulatory frameworks that shape them. And the second theme around consumer decision making, we believe a key driver for new products and services should be to help consumers with complex decisions involved in managing financial risks effectively and affordably. Now, I'm not going to go into every single recommendation that we're making today. Those are available on the report that's now live on the actuaries.org.uk website. So I would encourage the audience at their leisure, not right now, but at their leisure to go and have a look at the report. But I'll probably cite a couple of examples just to give you a flavour for the areas of recommendation. So one that we're very keen on is collective defined contribution schemes. So they're expected to offer better outcomes for individuals than traditional defined contribution schemes. And because members pool their retirement savings into a single fund, they also pool and share risks associated with uncertainty about the performance of investments and how long they will live. And this risk sharing allows the schemes to invest in assets more efficiently and therefore generate higher expected returns. And we would like to see CDCs focus on employers because to get employer buy-in, because it is essential to have their buy-in for greater adoption. And so we would like to see government support for UK Pension Schemes Act 2021 for multi-employer and master trust CDC schemes to enable smaller employers to also have access to cost-effective CDC schemes. And a separate example relates to the Flood Re initiative in the UK, where that has shown how it's possible to enable affordable insurance of otherwise unaffordable risks to individual corporates or individuals. Flood Re is a reinsurance scheme set up in 2016 that was designed to promote the availability and affordability of home insurance, including cover for flood damage for eligible homes, especially those whose homes were at highest risk of flooding. And by 2019, 4 out of 5 households with a history of flood claims had seen their premiums half as a result. So the IFA is going to promote research into what factors make a model like Flood Re successful and how a similar approach could work in other areas of insurance where some groups in society are at risk of exclusion for reasons beyond their control. For example, pre-existing medical conditions or indeed pandemics cover. So in conclusion, I'd certainly like to thank everyone, the large audience for logging in today and engaging with this debate. I really look forward to engaging with panel members over the next hour or so to explore the trend and some possible solutions. And I think, it's worth saying that, no matter how the next hour goes, we certainly don't think this is the end of the process for the Institute and Faculty of Actuaries. We hope to engage and shape the Great Risk Transfer debate as it unfolds, and we want to draw on as wide a pool of ideas and examples to flesh out these initial findings and recommendations. We're going to focus on specific recommendations from the report over the coming months. We want to engage with influential stakeholders such as ministers, other parliamentarians, regulators and industry groups. And in parallel with policy engagement, we're interested in establishing a working group to further develop aspects of the Great Risk Transfer. So, to borrow from one very distinguished parliamentarian, we're hopeful that the publication of the report today is not the beginning of the end, but the end of the beginning. And indeed, for the sake of the public interest, we will do all that we can to make sure that is indeed the case. So thank you for listening to this opening introduction, and back to you, Polly. Polly? Is Polly frozen?
I wonder, John, whether I ought to make a start, perhaps, because I think I'm due to make a response to what you've said. So, shall I begin?
I wonder, Steve. Polly seems to.
Sorry, Steve. I'm so sorry. My internet cut out just at the wrong moment. Apologies to all of our attendees. Yes, Stephen, it would be brilliant to get your response politically from that. It's interesting, John mentioned the idea of, coming from a political ambition in the 1980s around risk and entrepreneurialism and responsibility, and perhaps that actually reduces our ability to take risks. So, Stephen, it'd be great to get your reflections on the political perspective.
Thank you, Polly. Thanks for inviting me. And I really welcome the very interesting perspective John and his colleagues have brought to this. I want to comment from a report published last month by the Work and Pensions Select Committee, which I chair, on pension scams. And I think this particular example highlights issues likely to arise in other areas as well, and indeed some that John has just touched on. The Select Committee inquiry on scams is the first part of a three-part inquiry looking at the impact of the pension freedoms announced by George Osborne in his 2014 budget. That's the Annuity Reforms John mentioned, and they were implemented from April 2015, so over the last 6 years. And what I want to suggest is 3 lessons from the pension freedoms experience about what should be done if risk is to be transferred onto individuals. Firstly, people need support to shoulder new risks, and it's not enough just to make the support theoretically available. We need to make sure it's actually taken up. And I think this is a case of the second group of John's 2 groups of lessons about help for consumers with complex discussions. So that's the first lesson I want to draw. Secondly, risk transfer does impose new and unfamiliar dangers on individuals. Safeguards are going to be needed, and they need to be carefully thought through and implemented before the transfer takes place. And thirdly, the threats arising from the risk transfer won't be static, they're going to evolve. So government needs not just to implement safeguards at the point of transfer, but to monitor what happens and to be prepared to update the safeguards when necessary later on. So taking those in order, before the pension freedoms, the annuity reforms John mentioned, pension savings accumulated with the big incentive of tax relief could only be used in quite a narrowly prescribed way. By the age of 75, they had to be used for an annuity, which would provide a dependable annual income for the rest of your life. And as pensions minister under the old regime, I saw quite a lot of frustration, particularly amongst people with larger pension pots, because the annuity income they were able to purchase didn't seem very much compared with what seemed to them a large pot that they'd accumulated. And a lot of people felt they could do better if they were free to invest the money on a freer basis. The Treasury always responded to those representations that if people did what they wanted, the savings might well be frittered away and the state would end up picking up the tab in means-tested benefit support. Now, George Osborne brushed those Treasury reservations aside in launching his freedoms in 2014. And I was one of those at the time who were worried when they were introduced about where this was going to take us. But I must say, looking back over the 6 years, the freedoms clearly have improved choice for savers in a way which has been popular. And I don't think now there's really anyone who would argue that they ought to be repealed, that we ought to go back to the old, much more restrictive rules. But there have been real problems about what's happened. Andrew Bailey, the Bank of England governor, told the Treasury Committee recently that the freedoms were introduced too quickly, and I think he's absolutely right. One result has been the surge in scams. The Financial Services Compensation Scheme levy to fund compensation is £1 billion for next year that financial services firms are all having to contribute between them. 2 years ago, the levy was less than half that. It was £400 million. There was a sharp rise following the freedoms. The Financial Services Compensation Scheme is clear that the effect of the freedoms is one of the reasons they've had to put their levy up so much at the cost of everyone in the industry. Safeguards which should have been provided were not. We do now need, 6 years too late, but better late than never, introduce some safeguards which ought to have been in place in 2015. A nurse in a health centre in my constituency, just around the corner from where I'm sitting at the moment, is married to a black cab driver. A few years ago, a financial advisor who'd given them good advice previously called about an opportunity to realise their pension savings early with no real downside, and they decided to take up his proposal. Today, all their savings have gone. They face a massive tax bill with no means to pay it, and the financial advisor is living on a yacht in the Mediterranean. Now, it's obvious to everybody how devastating the impact of that is on a hard-working family. The Pension Scams Industry Group estimates 40,000 savers were scammed out of £10 billion in the 5 years following introduction of the freedoms, and some of them don't know it's happened yet, and they won't find out until they try and take their pension. In the March 2014 budget, George Osborne said, and I quote, "No one will have to buy an annuity, and we're going to introduce a new guarantee enforced by law that everyone who retires on these defined contribution pensions will be offered free, impartial, face-to-face advice." He recognised that people would need support to handle the risk transfer, that you couldn't just leave people to get on with it. Now, the outcome of his promise is the free PensionWise service, which is operated under contract by Citizens Advice to help people understand their options when exercising the pension freedoms, the range of choices available, what's appropriate in which circumstances, how to spot and avoid scams, and so on. PensionWise gets very high satisfaction ratings from those who use it. 72% of them say they changed their mind about what to do with their savings as a result, which suggests that many of those who don't use it are making poor decisions at the moment. And I think that strengthens the case that John made a few minutes ago, that consumers do need help with making these complex decisions. But there's a problem about PensionWise. The problem is that only about 1 in 33 of those eligible for it actually use it. Last autumn, the DWP proposed some new nudges which according to the DWP's trials would increase the take-up from 1 in 33 to 1 in 9. Now, it seems to me that is completely hopeless. So I tabled an amendment last September to the Pension Schemes Bill to enrol automatically everyone approaching the age at which they can exercise their pension freedoms into a pension-wise appointment. My amendment was unfortunately defeated. The government opposed it. But the Pensions Minister, Guy Opperman, did agree in the debate that a pension-wise appointment should be the norm. So our report, published last month, has called for a plan and a timetable to make that a reality. We've got to do a lot better than just getting 1 in 9 of those eligible for that help actually accessing it. So that's the first general point I would draw from the pension freedoms experience, supporting the case that John made. People need support to shoulder this kind of new risk. And it's not enough just to make the support theoretically available. George Osborne's budget speech referred to a guarantee. We need to make sure that support for shouldering a new risk is actually taken up. Secondly, and I think this is an example of the first point, the recommendation that John referred to, the first group of recommendations about trying to shift some of these responsibilities back to institutions. In response to amendments drawn from our inquiry, the Minister promised in the Pension Schemes Act debates regulations so that if a defined benefit pension transfer application raises a red flag from a list drawn up by the industry as indicating a scam, then the trustees should refuse the transfer. The responsibility should shift back to them to decide whether this is a good idea. The regulations are being drawn up now and they should take effect this autumn. At the moment, if trustees are asked by a saver to move the money, even if the trustees know perfectly well that the destination for that transfer is a scam, the trustees have to move it. That's true even if the destination for the transfer is on the published Financial Conduct Authority warning list of likely scams. The saviour under pension freedoms has the right in law to do what he or she wishes with the money. The scammers are very clever people. They will groom their victims, telling them what the trustees are likely to say by way of warning, but grooming them to reject the warning, say this is just a ridiculous, bunch of fuddy-duddies who want to hang on to your money, and they groom the victims to reject those warnings and press ahead. And if the trustees are slow about making this transfer, then they can be fined for not being fast enough. So this is my second lesson of broader application. And as I say, I think it's a good example of John's first set of recommendations. This straightforward safeguard should have been provided when the risk transfer was introduced. Unfortunately, it wasn't. Thousands of people have had their retirements ruined as a result. And then the third point is this. A lot of the risks to savers now are online. The government has promised an online safety bill, which is intended to impose on Google and Facebook and others a duty of care for what appears on their platforms. But the government doesn't intend the bill to cover financial online harms. I've called on the Prime Minister in the Commons to tackle online financial harms in this bill, and he did in his answer recognise there is a problem. But as far as we can tell, that the government still doesn't propose that the bill will do that. So I'm planning an amendment to the bill when it's published, which we expect to in the next 2 or 3 months, to bring financial harms within scope. And I know there'd be very strong support for that in the financial services industry. The National Economic Crime Centre put it to us that fraud accounts today for about 1/3 of all crime in the UK, but about 1% of policing resources. And that mismatch is partly why we've got such a huge problem at the moment. So my third lesson is that if risk is transferred, safeguards need not just to be put in place at the point when the transfer takes place, but they need to be kept up to date as the threats in response to the risk evolve. Thank you, Polly.
Really fascinating, Stephen. Thank you. And I agree with everything you said. I think a couple of reports that attendees might be interested in that we've done around those issues include, last November, we did a report called The Great Cyber Surrender around exactly that. Basically, we've decided not to police financial fraud. And also a piece of work we did on how you might adapt the financial services products and services to provide more protection, protected by design, particularly for people with cognitive impairments who are, we think, 3 or 4 times more likely to fall victim to those kinds of scams that you've identified. So massively important ways in which we risk. How do you provide alternative protections, capability, support around them? And I want to ask Vicky Price to speak, to give I guess the economic perspective about the impact that these changes are having and what we might do about them. We've already had some questions come in on the Q&A. Do add your own questions, and as soon as Vicky's done, we will bring in some of those questions. Stephen has to leave us at past, so I'll prioritize any questions that you have for Stephen. So do definitely get those in quickly if you want to ask him something. Vicky.
Thank you very much. If I can make a few comments, and I really listen with great interest what John had to say and also what Stephen had to say, and just to take up what Stephen Timms has just been talking about. Just 2 days ago, I think we all read that a very large percentage of British Airways pilots are intending to leave, already are trying to transfer, have transferred out of their defined benefit scheme, which is really quite extraordinary, because basically there is a lack of trust in what perhaps may be happening to that company. And we've seen a number of times when the pension funds that have been established were left lacking, if you like, particularly when firms went into financial difficulty. So there is an element of that that's going on, which probably explains people's willingness to take the money out and do something else, which often, of course, may not make a huge amount of sense. But of course, what we've also seen, and the British Airways example is a good one, huge uncertainty because of the pandemic. It's the type of risk that hadn't necessarily been put into anyone's calculations in the past in terms of what type of response perhaps they needed to have to survive it. And we heard about reinsurance and the really important part that reinsurance can make. And of course, government-backed reinsurance facility is what has been asked in all sorts of sectors of the economy already. And of course, on the pension front, we do, of course, have a scheme that at least picks up the remnants, if you like, of a pension fund that exists and pays something. But there is huge concern about whether that is, of course, going to be enough for individuals who may be losing out during, particularly, we've seen that already, but during also the aftermath of the pandemic. We just heard today about the very large number of firms that are probably not going to be able to survive as we're coming out of the lockdown and as the furlough scheme ends. That leaves loads of people, of course, in difficulty. Some of them probably have had some pension arrangements, of course, which in a way now with the stakeholder pensions has made life easier, but nevertheless, the returns that people are going to be getting are not exactly going to be great in the long term. And we mustn't forget that there is a time preference, and that time preference for most people deciding whether they want to have a pension or what else they might do with their money basically suggests that you discount the future in such a way that benefits now are considerably more important than benefits later. And given that we now moved into what John Kay and Mervyn King are describing as radical uncertainty, those supposed risks which were low probability, we thought, but high consequence ones, like the pandemic, like climate change, may in fact hit us in such a way that making any plans for the future may not make huge amount of sense. And it's really interesting because a large part of what the report is talking about, with which I tend to agree, is educating and getting people to think again in relation to saving for the future. It just, first of all, reminded me of quite a lot of other research that has been done, which suggests that you could tell people, in fact, I listened to a scientist talking about how they were trying to get people to stop smoking or eating more healthily. They produced a lot of evidence as to why that is important and what the difference in life expectancy might be, which of course matters hugely here. And of course, there is a huge worry that we're talking about, putting money aside for your life after work or after a certain age. But of course, we know that there are huge differences in life expectancy in different parts of the UK, and different ethnic groups have different life expectancy as well, it seems, and the pandemic has thrown that into sharp relief, and that's a serious issue. But it's worth remembering, first of all, that in that particular study where they looked at what people might do in terms of changing their habits, they found that no matter how much you explained the impact of continuing as they are and the benefits of changing their behavior, that didn't have any take up at all. The only thing that really did is changes in the way in which things were presented in shops, possibly portions going down and so on. And also looking back at what happened during, or certainly the survey work that was done during the deliberations of the pensions, the Adair Turner pensions review that was taking place for a number of years in the early 2000s and mid 2000s, they came up, in fact, with some findings from talking to people, and they described the killer fact, which was that only about 0.5% of people make pension saving decisions on a rational basis. If that is the case, then something needs to give, and I think some of the recommendations made here are really quite useful in terms of at least taking some of the risk away, but people are not convinced that they need to save for their pension right now. And of course, they look at houses and the prices, which are continuing to go up. We just got some evidence again about how the number of transactions, the volume of transactions has been at the highest for 16 years, how prices continue to go up. And people obviously will perceive that that is perhaps a better way of putting the money into something that will earn them some return that they can be more or less certain about, than something which they discount in such a way that has very little value for the future. So a lot of the recommendations therefore in terms of someone taking the risk away and someone doing something for them, which has already happened up to a point, of course, but taking it back in a way that ensures that the savings happen is crucial. And I think I agree entirely with what the report is saying. But nevertheless, the pandemic has not only shown those regional differences, those differences that exist between people's health, but also they have shown that we're coming out of it with huge wealth and income inequalities. And that's a serious issue. So not only do we have a large number of gig workers who the gig economy generally is made up of workers who do not put money through a firm on occupational pension schemes, and that is a serious issue of discrimination at the end of the day. So we have all those to worry about. That number has been quite substantial and could in fact increase if we move more towards sort of working from home and having types of people who perhaps are attached to a firm but don't necessarily have all those benefits that others do. We've seen the issue with Uber and the judgment that's been made, which classifies people as workers. That, of course, would probably mean, and I'm not sure that what the regulation is saying, that they would be entitled to having their employer pay a certain percentage of what they earn into the pension schemes, into some pension scheme as well. Now, that, of course, is not clear. It hasn't quite happened yet. And of course, it would be incredibly costly for the likes of Uber, for example. We have women who, as we know, work part-time, to a considerable extent. I think 42% of women in the UK work part-time. They don't collect, of course, they don't earn enough to put money into occupational pension schemes to the extent that others do. And of course, although there have been changes in terms of the state pension, nevertheless, by the time a woman reaches retirement age, her pension wealth is only a fifth of that of men. So there are all these inequalities there that need to be dealt with. I don't really think we can just change things, but just explaining to people why they should save. Obviously, if you ask people, again, why do they not save for their pensions? I looked at a Prudential survey done in 2015. 50% of people said, we just don't earn enough. And that is a problem here in the UK, but of course we've seen that happen elsewhere too. But those are issues that have to be absolutely tackled. The inequality, the low pay at the lower end of our pay scale, which leaves also people incredibly financially exposed. And an FCA survey that was done just recently found that an extra 3.5 million people are now joining the ranks of those who are in financial distress. Expecting these people to also worry right now about saving for their retirement is probably too much. And I worry that coming out of the pandemic, those issues are still going to be there for the pensions industry and for our welfare system, which will need a lot more attention. Hopefully some of the schemes, ideas that have been discussed today and in the report will make it easier also for small firms to be able to provide something sensible to their employees. But I'm suspecting that an awful lot more needs to be done, not just the scams that are out there, but how to get people to save for their old age, if you like, when the circumstances we're finding ourselves in now are so stacked up against it. I'll stop.
Thank you. Thank you, Vicky. Really helpful. Slightly depressing reminder that this is really tough, and expecting people to just be able to absorb all of this risk, even with better support, more engagement, remains really, really challenging. I want to just come back round and get your initial reflections on what other panelists have said before we add some of the questions from the Q&A. John, I know you wanted to talk about annuity reform in particular.
Yeah, thanks, Polly. Yeah, no, it was wonderful to hear the contributions from Stephen and Vicky. I think I'm entirely in agreement with all that's been said from both of them. And the annuity reforms in the UK is, I think, a fascinating case study, and I'm pleased to hear yet again from Stephen, his kind of personal involvement in trying to mitigate some of the harms that individuals have been exposed to, perhaps as a result of the reforms being implemented kind of too quickly. And we'd very much support continued measures to help individuals embrace the reforms as well as they can. And I do wonder, if there are some broader issues at play here too. So for example, I see in some of the questions coming through, there are questions about the supply side. So are insurers reluctant to offer annuities because of the regulatory environment or so on? And, I've got an open mind on that, but I would observe that many insurers are quite active in the bulk purchase annuity market, which is a kind of institutional marketplace where they quite happily take on investment and longevity risks. So my instinct is they have the capability to offer more annuities if they wanted to, but they're in an environment where consumers generally believe drawdown is very popular, it's fashionable, and they don't have to buy, they can get away from annuities. So from a product provider's point of view, offering to them a lower risk drawdown product that is popular is of course a natural thing to do. But I would hope that as consumers become better informed, perhaps with the help of advisors or pension wise, they start to gain a greater appreciation of the longevity risk that's inherent in drawdown, which in turn might create demand from on the sort of consumer side for better products. I mean, there was I remember one industry analyst said 5-6 years ago that the reforms would create a tsunami of innovation, and I haven't seen it yet. So I'm hoping that a renewed interest and awareness of longevity risk will create a demand for the types of pooling that I think many of us would regard as a rationally sensible outcome And it may well be that in addition to advice to counter some of the emotional considerations that Vicky was describing, maybe some defaults, building on the success of auto enrolment nudges and using that in a post-retirement place might also help to achieve better outcomes for consumers. So in summary, I think this is a long way to play out just yet to make sure that consumers aren't excessively cautious in retirement, that are underspending after saving so long, or indeed excessively reckless and making better decisions once they become better informed.
Stephen, you had quite an optimistic take, I think, about the value that advice, if it were at least properly provided and embedded, could contribute. Do you feel like we can change consumers to kind of tamp out their cognitive biases and make them not quite so, I don't know, to hit that sweet spot that John was just describing?
Yeah, I think there is the chance to do that. As I say, the Pension Wise service, which is up and running and is completely free, it's very well regarded by those who take it up. And a lot of the people who do make the point that they feel much better kind of protected against falling into a scam than was the case before they had it. So I think there is a lot you can do with guidance. I noticed the question's been raised, is there the capacity to provide this service to such a large number of people, given that such a small proportion at the moment take it up? And I think the answer is yes, if the government was to fund it. I mean, of course, it would be costly, but George Osborne, when he launched his freedoms, was absolutely clear there would be a guarantee. And if you look at what was said by ministers in the couple of years after that, the assumption was basically that everybody would have this guidance. It was only, as things came to a point of being actually implemented, that it was kind of, we've ended up with something much smaller. But there's no reason at all, if the funding was there, why it couldn't do the job which George Osborne said needed to be done at the start. On John's point about, I don't think there's a problem with the industry in providing the annuities that could be. I think the problem is that if you look at how much income you get from what feels to you like a large pension pot, you don't get very much per year, and it's sort of attractive to look around for other things which are going to get you a bit more money. But I think if we can get people some better guidance, we might make more headway. Vicky's point I thought was very interesting about British Air. I hadn't seen that report yesterday about British Airways pension scheme members wanting to move their money out elsewhere. I mean, we've seen this with British Steel, which was an absolutely catastrophic case of people with decent pensions being persuaded to move them out to more exciting things. And in some cases, they've ended up with nothing at all. In lots of cases, they've ended up with much less than they would have had if they'd left their pension in the British Steel scheme. And I suspect we may well, given what Vicky's been saying, I suspect we may well find the same thing again with British Airways before too long.
Yeah, Vicky?
Yes, well, perhaps I'll just add something, because there was a question about, whether people say, of course, that they don't earn enough and therefore they don't put money in for a pension for the future, but they do make a choice about whether they want to consume or perhaps save instead, unless they are on subsistence income. And I think that's absolutely true. And the same survey that I mentioned before by Prudential also did say that about 50% said they didn't earn enough. And then when questioned a little bit more, you found that perhaps a third said they could possibly put a little bit more and spend a little bit less. But here we have a government, of course, right now, which is encouraging us to go out and spend all the savings that have been made, which are calculated as somewhere between 180 billion and 250 billion. And our Prime Minister said, go out and spend it. And of course, we had at various stages. Rishi Sunak also encourages us to do exactly that. And of course, we need to support retailers and everyone else and pubs, of course, which is fine. But it just gives the wrong impression again. Now, what will people do? In my view, there is a lot of caution around. We don't know what's going to happen when the furlough scheme ends, which is going to be ending soon. And there are still nearly 5 million people, or perhaps 4.5, 5 million people on furlough at present. So they may not do that. They might start thinking about risks a little bit more. Maybe the pandemic is a good opportunity for people to think that, you know, maybe these things are happening quite frequently and we need some sort of way of ensuring that we have enough savings to survive in the future. That might change the way people think. On the other hand, very low interest rates, just thinking about, you know, what people think the pension funds might do in the future, very low interest rates, which of course are not earning anyone very much. And that needs to be put against, of course, if you're deciding whether to spend or not, keeping your money, you know, under a mattress. If you're not earning anything, it's more or less the same thing, really. Leaving it in the bank is like just keeping it under a mattress. And we now have inflation reappearing, not in a huge way, but the forecasts are that we're going to have maybe 2% inflation in sometime in the next few months. And of course, you know, you're losing money if you don't spend it as quickly as you can. So it's going to be interesting to see how the consumer feels at the end of this.
So, Stephen, we're going to lose you in just a few minutes. So I want to ask a question from Ronan Cocky. You know, should insurers be lobbying the government to rebalance these risks back to financial institutions? You know, you've focused on what positive action can insurers be taking to actually try and move some of the dial back in the other direction. I mean, we've already talked about, you know, the bottom end of the labour market, the casualisation of labour. Is that something where risk should go back in the other direction?
Sorry, Polly, I missed the beginning of what you said. What was the question?
Sorry. So it's the question, should the insurance industry be lobbying for some of this risk to
Should we be lobbying for some of the risk to go back to them, you mean?
Yes.
Well, I'm not sure whether the insurance industry is going to lobby for that, but I think politicians should be pressing for it. I mean, I think the example that I gave, the regulations will deliver, which is that trustees can say no to transfer requests if they can see that that the transfer would be into a scam. I think that probably is an additional responsibility that trustees will welcome, and maybe insurance companies will as well, because, you know, nobody wants their members or customers to lose the kind of volume of savings that we have seen lost over the last few years. So I think that would be in the interest of insurance companies and the industry. And I hope that people will welcome that new responsibility when the regulations allow them to shoulder it. But I suspect that in other areas, it's going to require politicians, it's going to require the public, it's going to require Parliament to say that we want you to take on this additional role to safeguard your customers, because as John has explained, you've got the expertise, you're in a better position to do it than individuals are.
Fascinating, and thank you so much for joining us, Stephen. I'm sorry you have to step away. I want to come back to John and Vicky with this question that was the first question we were asked, actually, around calling it, you know, is it fair to call it a great risk transfer? Obviously, great can mean big, not actually just wonderful. But that's fundamental question of, is this just a systemic failure? It seems to me that, you know, technology and data enables us to personalize services so much more. And in some ways that feels like better, but the danger is it reduces pooling, personalized pricing, which we've seen in insurance markets for a long time, but may come into a whole range of different kind of consumer markets. And that in the end reduces a sense of solidarity and pooling between citizens within a society. So is this just a macro trend we need to get used to? Or is there a way to put some of the genie's foot, at least, back in the bottle? Vicky?
It's interesting you asked me first. I was expecting John to come, but I want to make a comparison between what we're talking about here and the Grenfell Tower, and the fact that you just can't get insurance now, and all the risk seems to have shifted to the tenants, the people who are living there, not only in terms of the human cost, of course, that we've seen, but also the inability for people to move out of places which have had the type of cladding, not having the insurance. The government has stepped in a little bit and saying, yeah, we're going to give some guarantees for a number of people who are affected by this. But what you really need is much more comprehensive support. So this is a good example of how this risk is transferred again to the individual without having that type of support at the back in relation to some government guarantee or insurance that takes up all those issues that people are worried about, and therefore they can't move houses. So it's an interesting comparison, and you can extend that, because the pandemic is a similar one too. I mean, look what happened in relation to all these companies that were not able to function properly because of the interruption of the coronavirus, which then, of course, led to the government saying you have to close down. Okay, so big fight to try and get the insurers to pay for it, because it was indeed a sort of a disturbance of business, and some thought that the writing in the insurance policies was such that it covered them. And of course, it had to go to court, and a number of insurance companies, of course, did pay up. But what we're hearing since is that they're going to be changing the wording just to make sure that it's quite clear that these areas are not covered in the future. I mean, you did mention the flood insurance earlier. At least I think we did for this session, rather than what we were discussing before. We got to open up to everyone else who's listening to this. But this is quite similar. So in other words, once again, what we're seeing is that this risk has been transferred to, in this particular case, of course, it was firms, small firms in particular. But of course, then that impacts also their employees, whether they can expand, what's going to happen in the future, the amount of money they're able to pay, if they also have to think of how they can insure themselves against things of that sort in the future. So that transfer has perhaps happened a bit too much in a number of areas across society, including the dealings, for example, the way we use digital technology right now. It's us who have to do all the work, basically, whether we want to book a flight or we become the cashiers in various places instead of having a cashier at the other end. And yet, before there would have been someone who takes your things and doesn't. So it's the sort of thing that irritates quite a lot of people if they have to do it, especially if they're useless at it like me. But again, what has happened is there's been a transfer. So the company makes profits out of using you to do various things that you actually can't do particularly well. And as an economist, you immediately think, opportunity cost here and division of labor. It's not working quite like that. And it makes you also quite unproductive at the end, at the point of the consumer, rather than the point of the company, which actually makes profits because it hires fewer people to do this sort of thing. So I think there's been a systemic, I'm going to call it that, or systematic, one or the other, or both, transfer of risk to individuals, which is quite dangerous. And that's why I really rather like the proposals in this report.
John, your reflections, and in the questions, there's lots of challenge, I think, to the question of can collective DC or the hybrids that you're talking about, can it really work? So it'd be great if you could cover that as well.
Yeah, happy to do that, Polly. And I think one of the questions I think you were posing originally was essentially have some of the horses bolted, and we're only laterally trying to call out this and close the stable door. And I mean, I think that's undoubtedly true in some instances. So for example, employers' appetite to run defined benefit contribution schemes, again, I think will never return, certainly not in the foreseeable future. So I don't think there's, much as we might lament that change, I don't think we would seek to turn back the tide at the risk of mixing metaphors. But I think where there are opportunities is around, I think, collectivizing and pooling risks together. So one of the nice things about CDC for employers is that the risks are shared within groups of employees. They're not actually borne in any substantial measure by the employer. So the employer certainly needs to provide the operational support, the administrative support to get it up and running, but doesn't need to supply the balance sheet. And that's a critical difference. And so other opportunities for collectivising risk, I think, are important. I gave a little example in my talk about how it could be done in the world of drawdown and retirement provision. So I think there are opportunities to protect some of the horses that haven't yet fully left the stable. And I think, you also referred, Polly, to the idea of insurance pricing being very increasingly individualized. Now, I think that my own view is that's simultaneously a good thing and a bad thing. So let me give you an example of the good thing. So a young motorist might have considered motor insurance to be prohibitively expensive, but through the advent of telematics, they can adhere to a curfew, demonstrate that they're driving slowly, and suddenly the insurance becomes affordable for their purposes. That's got to be welcomed. But of course, where there are other individuals who maybe, for example, with their family history or their existing medical conditions, get excluded from insurance, that's clearly a bad thing. And we'd certainly encourage government to be alive to this growing trend and anticipate it before it really becomes a significant challenge. But that's a live innovation that's happening at the moment. And as I say, it will happen. And we should, while we welcome the positive aspects of that, we need, I think, policymakers to step in and address the detrimental aspects before they become too significant.
John, one question is around why innovation in longevity transfer products has been so disappointing. And, you mentioned earlier how, the pension freedoms were supposed to give rise to massive innovation. And I remember when I was in government talking to Andrew Dilnot, and not that the Dilnot cap has yet, though who knows, maybe it will come in. But the idea there was that having a cap on social care costs would unleash innovation. And yet, in some ways, this market doesn't seem to be innovating. You understand the markets much better than I do. Is that something we could do to help innovation? Or in the end, should we just be thinking instead about the state as the answer to picking up some of these impossible or uninsurable risks?
Yeah, no, it's a really fascinating question. And, we do have to, I think, reflect on why has innovation been so limited. And as I kind of alluded to earlier, I think the insurance industry may well have the capability and so on to step up and support some of the risks that consumers should be looking for support on. But I suspect what's happening is largely a demand side failure, because the relatively uninformed consumer maybe doesn't appreciate the need for longevity insurance. If I start to think of my own retirement, which maybe isn't too far away now, trying to plan for a time horizon that might only be 5 years or might be 35 years, that's really hard to do without a pooling of risk that's happening. Yet many individuals don't have that perspective. I think as I was saying earlier, they just see breathing a collective sigh of relief that they don't need to buy one of these inflexible, poor value annuities, and they've got this great drawdown product that they're delighted to be in. But I think it's only as they become educated, or their advisors become educated, or policymakers intervene to say, actually, you're running a longevity risk that is pretty difficult to manage at individual level, that we might then see a response from the industry. And we have seen some examples, in Australia and elsewhere, where we've seen pooling of longevity insurance embedded in drawdown. And I would like to think we might see more innovation like that in the UK. But for the moment, the demand side part of the equation isn't really calling out for it just now. And I think that's where we need a bit of stimulation, or indeed government impetus.
There's a more cynical take from Martin White in the chat, saying financial sector innovation is just driven by the profits to be made. Vicky, are you on that cynical side? You've been essentially the chief economic advisor to government. Do you think in the end it should be the state that's picking up the tab here?
I think, like on everything, it should be a hybrid system. But I did smile when I saw the comment that financial sector innovation basically at the end of the day just is a clever way of extracting even more from the unwitting customer. And it's more or less what I was trying to refer to before. But there have been some quite positive innovations that have been very helpful. And we do have a lot more access to borrowing than we did before. And there are ways of bypassing the system too, and having much lower costs in terms of the way in which we want to transfer funds and so on. That may, of course, all change post-Brexit, but what we have seen is that there have been quite a lot of sort of beneficial impacts on people's access to finance, for example, and also, frankly, in terms of being able to shop around and get the better insurance that may be available out there. So I wouldn't go as far as to say that every innovation leads to perhaps some detriment to the consumer. It could be both. Yes, more profits to financial institution and also better service. It isn't always the same, the case, in fact, that this is happening, and we need to watch it. But I think the government has a very important role in this. I mean, after all, it was the changes that were made after the Pensions Commission that made pensions accessible to a much larger percentage of the population. Of course, you can still opt out, but at least you had the right to have one. And that has been very good news. So some of the things that the government has instituted in terms of the changes that have taken place, plus the government, of course, having a role in that too, have been very beneficial. And I see this hybrid model as being probably the best way forward.
Yeah,
so we've talked primarily around, pensions and lifelong savings. We've also touched on kind of casualization and risk transfer in the employment market and other kinds of consumer pricing. Again, I just want to come back to John before we're going to close a few minutes early because, having lost a panelist, I don't want to keep everybody, give you 15 minutes to get back to your lunch. What would be kind of top of your list, John? And then I'll come to Vicky before we close. Top of your list of something that we could address to help improve kind of consumer outcomes across this range of issues we've discovered.
So if I'm greedy, Polly, I might offer you a list of maybe three.
Okay. So just let's not turn this into Desert Island Discs.
That's right. So I think the first is just calling out this trend. It's been in some ways an insidious trend that many individual instances of this, which in aggregate has a tremendous impact on the risks borne by individuals. And I'm not sure that, when we started talking about this a year and a half ago, we had a full appreciation of the extent of it. And I do think it's worth calling out so that policymakers and so on are really alive to this impact and may have a greater appetite to act on it. So I think it's just an awareness, first of all, that this is happening. And then I think the two areas that two specifics that I mentioned in the talk. So CDC has an opportunity to help during the accumulation phase, and also can be a vehicle if it's regulated and legislated for in the right way, to be a vehicle for drawdown arrangements where risk sharing takes place. So CDC as a vehicle has an opportunity to do a lot of good in the pension saving and decumulation space. And then secondly, the flood re-type model, because of the technological and data innovation, I think the need for this in multiple areas of insurance is just going to grow at a rapid pace because of the pace of technological innovation, and making sure government policymakers are ahead of the curve and seeing the need to deploy such a model before too many consumers or businesses are impacted, I think would be a wonderful takeaway from this. So I hope that's not too greedy, Polly, but that's my three big asks.
I'm happy for you to take three to your desert island. Vicky, what's your kind of top one or three?
Well, I think I would still maintain that given the current uncertainties that exist and the risks that are out there, and given the low interest rates, given the time preference that people have, it's a hard ask to get people to willingly save rather than go out and spend. And that's going to be a problem that needs to be dealt with. But there are whole issues where at least we're getting people who are working for firms getting some cover, and certainly also access to occupational pension schemes, which are, at least give you some assurance for the future of sorts, given that, of course, who knows what's going to happen in a few decades' time when one reaches retirement. But it doesn't really work well for the self-employed. So I think a lot more emphasis needs to go into how do you get these types of schemes that we're talking about to be the right ones also for them, so they don't lose out. What's happening right now, of course, with the young, there was a question certainly in the chat box about families and the young, and how do we educate them and get them to also worry about the future or think about the future. Well, we all know that during this pandemic, it is the young who have been most affected, loss of jobs, and the percentage has been extraordinary in terms of the impact of the pandemic on youth. Those people are the ones who have lost out hugely in terms of prospects, careers. If that doesn't get re-established somehow, then again, this is another big section of the population, which of course you want to start worrying about all this, who are going to be lost to the pension industry, if you like. And that's the second ask, if one could perhaps think a little bit more about how to get those people also to be part of the overall move towards ensuring that there's a better pension offering in the future, because otherwise we are going to end up, as I was saying, with a very, very unequal society. So and the state's responsibility, I think, is great in this. And perhaps the final ask would be, perhaps we shouldn't be encouraging everyone to just go out and spend, but change the rhetoric a bit and say, here we are in a collective way. And there was another very good question about, can we get everyone together to agree on this and the importance of it, including trade unions? I think it is a good idea if one were able to do it. And maybe, what John and the team have put together can allow us to move forward in that direction too. So, I mean, I'd like to end with a bit of hope rather than the terrible pessimism with which I started my comments earlier.
Thank you very much, Vicky. And surely through the pandemic, we have learned the power of 3-word slogans. And so instead of spend, perhaps we should have spend, save, and invest as the new Brilliant. National public financial health messaging. Thank you so much to John, to Vicky, and to Stephen for joining us for this discussion. I'm going to post in the chat to everybody the link to the really excellent report. Cannot recommend it highly enough. The Great Risk Transfer, which the IFOA published as a result of a whole program of work. There's lots more work that Demos has done in this space as well, looking at, for example, financial services products for the self-employed, which Vicky has mentioned. Please do sign up for updates on our website, or just stay in touch with us on social media. And do get in touch if you are interested in working with us or exploring some of these issues in more depth. So without further ado, we can all go get some lunch. And thanks again to Vicky and John and to the IFOA.
Thank you.